Towers, Managing Director of Towers Business Development. Welcome to this webinar today. Yes, your business can raise capital. Very important for private companies to have a clear understanding of the opportunities that are now available in Australia to be able to raise capital to fund your business operations. And I'm going to discuss some of these matters with you this afternoon, because this is the type of work that we perform at Towers Business Development, assisting companies to get themselves investment ready to be able to raise capital. My background is I've been a listed public company chief financial officer and company secretary, and I have contracted to Oz Industry for 11 years to deliver the COMET program, Commercialising Emerging Technology. And a significant part of that role was to assist a company to become investment ready to be able to raise capital. And one of the key sections that we tried to raise capital, in fact, the only one we were able to use, was Section 708 of the Corporations Act, which we'll be discussing today. Now there are some additional ways that private companies can raise capital. We've only had these for the last 3.5 to 4 years. Crowdsource funding, equity raising, and early stage innovation companies. So it's a lot easier today for a company to be able to raise capital if it has a vision and a leadership team that wakes up every morning with a real urge to get on with the day's activities and implement the vision of the business. So let's look at Section 708 of the Corporations Act. Now, this section was first introduced about 35 years ago. Prior to that, it was very difficult for private companies to raise capital. But a private company under Section 708 can raise up to $2 million without issuing a prospectus. So the general requirement, if you want to raise money in Australia from the public, you should issue a prospectus. There are some exemptions to that. We're going to discuss a couple more of those later on in this discussion today. But the big change when 708 was introduced was that the private company no longer needed to produce a prospectus, but there's a $2 million capital raising limit in a 12-month period. And the number of investors that can invest in the company is limited to 20 in that 12-month period. But also in a private company, you might know that there is a 50 shareholder limit. So as private companies go about raising capital, they need to be very careful that they're not going to exceed the 50 shareholder limit when that capital raising is concluded. And another big restriction is that raising money under Section 708, there can be no advertising. So it's basically capital raising amongst a family or close friends and colleagues, people who you know very well, or people who you generally come into contact with in your daily activities. But you cannot advertise in any way. I think a company aspiring to raise any amount of money, whether it's a couple of $100,000 or $1 million or $2 million, needs to have documented a business plan so that that's available to be handed across to the investor to review, because the investor wants to know what you're going to do with his or her money. And they also want to know what your vision is and what your strategies are. How are you going to turn this investment that the investor's contemplating making with you into a worthwhile investment from the investor's point of view? And the company should have financial projections. budgets, cash flow forecasts, projected balance sheet, which is really creating a financial picture of the vision of the leadership team and the directors as expressed within the business planning documents. So they're the sort of documents that are required for raising capital under Section 708. It's still appropriate. In fact, a lot of companies still raise capital in this way from their friends, their colleagues, their associates, because they do not have to advertise or promote it. They can just make phone calls and send documentation around. And then it's very simple. These companies don't need an auditor, and they can do it for a couple of years, probably. The 50 shareholder limit is one of the obstacles that they need to avoid. The next activity I want to talk to you about is crowdsource funding equity raising. Now, this was one of the two new types of companies that came out of the coalition government's December 2015 innovation declaration by then Prime Minister Malcolm Turnbull. Turnbull committed Australia to being far more proactive in assisting younger companies who aspired to grow. In lots of ways, we were not a world leader in this. We were playing catch up because the United Kingdom, the USA, Canada, parts of Europe, Singapore, New Zealand had had crowdsource funding for anywhere from 6 to 7 or 8 years when Australia finally decided to do something about it. So we were not a world leader in this area. But crowdsource funding has turnover limits. The group turnover of the company has to be under $25 million in the previous 12 months. The group gross asset value also has to be under $25 million, and it's the international group asset values. And the company cannot be listed on a stock exchange anywhere in the world. The company will need 2 directors once it becomes a crowdsource funding equity raising company. As you know, a private company at this stage only needs 1 director, can have more. The minimum for a crowdsource funding company is 2 directors, can have more. The government introduced this concept of a crowdsource funding intermediary into this legislation. The government called for expressions of interest, and I understand they received over 380 applications from businesses around Australia who held Australian financial services licenses, because that was the specification. From that original number, the figure that were invited by the Australian Security Investment Commission to be intermediaries was originally 6, and it has been subsequently increased in a couple of newer times of appointment to 16. The crowdsource funding intermediaries are located basically in capital cities around Australia, with the bulk of them being in Sydney and then Melbourne, followed by Brisbane, Adelaide and Perth. There is no intermediary in a regional area that I'm aware of. The intermediaries, some are very active. In fact, 2 are leading the deal flow at this stage in Australia. That's Virtual in Melbourne and Equitise in Sydney. But there are 2 or 3 other firms of intermediaries who are active in the market. And the others, well, we don't quite know what they're doing. But if you're looking to raise capital, you best talk to one of the ones that are active, and we can give you advice on that. Now, the intermediary's role is they wear 2 hats. When the now Prime Minister, who was then the Treasurer, Scott Morrison, introduced this legislation to Parliament, he called the intermediaries the gatekeepers. They're the gatekeepers for Australian Security Investment Commission, because they have to review the documentation that the company has to submit to become a crowdsource funding equity raising company to the intermediary who conducts a due diligence review. So the intermediary has to satisfy the legal requirements as overviewed by ASIC, that the company has fulfilled all of the requirements to be a crowdsource funding equity raising company. So that's obviously turnover, value of assets, the two director rule, not being on a stock exchange, but it then involves other things. There's a lot of information has to be submitted on directors and officers of the company, and all this needs to be embedded into a document known as a crowdsource funding offer document. The crowdsource funding intermediaries have got very wide powers. They are the final arbitrator as to whether a company is going to be allowed to list. And in the listing process, if something abnormal occurs, the intermediary, in fact, can halt the capital raising process. But more about that in a moment. The second role that the second hat that the intermediary wears is as a promoter. The intermediary businesses are all in the capital raising industry, and they all have businesses who have listed with them that they are interested in receiving details of companies trying to raise money. So they all have extensive databases. Virtual in Melbourne indicate they've got about 50,000 people on their database. Equitise in Sydney talks about 25 to 30,000 people. So that the intermediary will promote a company to their databases once they are satisfied and they have listed the company. The actual listing is on the intermediary's website, and that is the only place that an investor can go to invest, because every investor has to sign the acknowledgement of the conditions of the capital raising, and indeed the acknowledgement of risk. The government was very insistent that a risk report had to be handed to every investor, a risk summary, which is quite tough, but it does alert an investor that investing in these types of businesses can be risky. There's been well over 100 companies now raise money around Australia. The maximum that can be raised in a 12-month period is $5 million. And the system is now working to generate the ability for companies to raise capital. To be able to go through this process, the company will need a business plan, because this is the foundation for the document that has to be shown in the listing, and that's the offer document. But you'll need a business plan first, and you'll need budgets and cash flow forecasts, which clearly articulate what the expectation is for the company over the next 3 years. And I'm certain that the crowdsource funding intermediary will want to see both of those documents, because it's part of their due diligence review to see whether your company meets the guidelines of being a well-run, sound company that's got a vision. The offer document I've referred to earlier, it's the de facto prospectus for this capital raising. Will not cost anywhere near what a prospectus on an initial public offer on the stock exchange costs. Those documents are in the vicinity of $1 million these days by the time that process is finished. The crowdsource funding offer document has to be submitted to the intermediary that the company has selected. So you're not told that you've got to deal with a specific intermediary. You can talk to 16 of them if you like, and reach your decision as to who do you think is going to be the best person for you to work with. The listing on the intermediary's website is only available for a maximum of 90 days. The law says you've got to be able to raise this money in 90 days. And the intermediary does the bulk of that work. Most of the intermediaries charge a startup type fee of about $2,000 to assist with some initial promotion. And then they will contract with the company that their fee will be somewhere between 6 and 8% of the capital raised, depending on the targeted amount of capital raising. The intermediary does not get paid that fee until the capital is raised. And then they deduct it from the amount of capital that's been raised. You specify the minimum amount of capital you want to raise, and you can have a maximum amount that's also disclosed in the offer document. And if so, you have to submit in the offer document and to the intermediary details of what you will do with any extra amount. So you may have specified the minimum capital raise was $1 million, but you could have a maximum capital raise of $1,750,000. You then have to specifically identify what the company's going to do with that extra $750,000. If the company does not raise its minimum subscription, say $1 million, then all of the money has to be refunded, 100% of it, to the people who contributed their money as part of the application. Pardon me. So that highlights the necessity from the intermediary's point of view to make sure that this is able to be sold to the public. Pardon me. If the company raises the capital, the intermediary deposits the net amount after their fee into the company's bank account and sends the directors a list of the new shareholders. The company then has to issue share certificates and lodge a return with ASIC within 30 days of the capital raising being concluded. So that's the capital raising process, and that's how it works. You don't have to appoint an auditor unless the company has raised $3 million in aggregate from all sources. I think companies should appoint an auditor, but that is not required by the law until the company has raised $3 million. That's the process of crowdsource funding equity raising. For those of you who are online, if you have any questions, please type them into chat and I will answer them later on. If you're watching this webinar in your own time, more convenient time for you, and you have any questions on any matter I'm discussing, please send me an email, peter@towersbusiness.com.au. Let's now turn to the third way that a private company can raise capital. Early stage innovation companies was the stablemate of crowdsource funding equity raising when the legislation was introduced into Parliament. But somewhere along the line, the two pieces of legislation became separated as various Senate committees and others raised questions. So in fact, early stage innovation company was signed into law by the Governor General about 6 months earlier than crowdsource funding equity raising. And I think it's very unfortunate that a lot of people, business operators, directors, accountants, don't seem to know too much about the early stage innovation company, because this was one of the government's key agenda items to introduce a way to make it more attractive for investors to invest in young Australian companies who are doing something in the technology development area. So early stage innovation companies, I cannot imagine, are going to be running retail shops or professional firms. It's innovation that the government was looking to assist by bringing these companies into play. So the primary target group is young companies under 3 years of age. Doesn't mean the executives have to be young or the directors, but it's the young company that's under 3 years of age. There is a loophole that companies aged up to 6 years could be admitted, but if you need details on that, either consult me or your accountant or solicitor. There is an expenditure limit on the companies that meet the requirement to be classified under this classification, and that is $1 million of expenditure in the previous 12 months. So it's not a lot of money. As I said before, they're young companies. And there's an income limit. And the income limit is $200,000, not including any grant under the Accelerating Commercialisation Grant, which we're going to refer to a bit more in a moment, that the company may have received. But generally, it is $200,000. Again, very small. And a lot of these companies will have no income because they've been conducting experiments and research and development activities. And the company, once it goes through that first series of tests, turnover under 200,000, expenditure under $1 million, aged under 3 years generally, it then moves into one of 2 additional tests that has to pass. So let's have a look at those tests. There's the gateway test. Now, in the gateway test, the aim is to accumulate 100 points. And if you do that, and document it in what we call a due diligence report, the company has qualified as a accelerating commercialization, as an early stage company. Now you can do this by research and development, and research and development falls into 2 categories. Remember, we've got to accumulate 100 points. If the percentage allocated to research and development as a percentage of the total expenditure is over 50%. So in other words, if the company had spent $260,000 on research and development and the total expenditure was $500,000, they've spent more than 50% of their expenditure on research and development, they earn 75 points. Now, this is research and development that has been submitted in the company's tax return to the tax office. So they're claiming the research and development incentive rebate. If they had spent somewhere between 15% and 50% of their expenditure on research and development, they would earn 50 points. If they've been admitted to the Accelerating Commercialisation Grant Program, which is a grant program operated by AusIndustry on behalf of the federal government, they would earn 75 points. Now that grant can give the company a maximum of $1 million for work over a 2-year period on a 50% basis. So the company would have to have justified they've got $2 million worth of work to do. And the early stage innovation company capital raising could be where the company is going to try to get its contribution to that type of grant requirement. If their company has been admitted to an accelerator program, these are special business incentive programs undertaken in most capital cities. If they've already raised part of their capital in excess of $50,000 from arm's length investors. So this is not the founders of the company, it's new people who have looked at the vision, looked at the idea, looked at the research that's been undertaken, and say, I want to invest in this company. So they earn 50 points for that. If they've got a patent or a plant breeder's right anywhere in the world, they earn 50 points. If they got an innovation patent or a registered design, they earn 25 points. If they got an agreement for research and development activities under the Higher Education Funding Act or the Industry Research and Development Act, they earn 25 points. So you add all that up. If they got 100 points and they're able to be verified, and in our system, we have designed various forms for the directors to sign, certifying each of those requirements and putting the documentation there. So that's available for submission to investors, because we're coming to investors in a moment, because they're very important in this process. Obviously, they're going to put the money into the company and they want to make sure that they're going to receive the benefits that the law indicates they will get, as long as the company has met the requirements to be an early stage innovation company. If the company doesn't pass the gateway test, all's not lost. They can then move into the principles test. Obviously, if they've passed the gateway test, they're given the status of an early stage innovation company. So the first of the 5 principles tests that they have to answer: is the company genuinely focused on developing for commercialization one or more new or significantly improved products, processes, services, marketing, organization, or methods, marketing organizations or methods? So is the company doing that? That's to say yes and be able to justify that. Normally, at least one A4 page of argument for each of these questions. Some cases, it can be a lot more. Does this company have high growth potential? Does the company have the ability to successfully scale the business? Nearly another way of saying high growth, but can it manage it? Has it got a vision for how it's going to manage growth? Because that's what scaling a business means. Leadership team, board of directors, an appreciation of what's required. Able to address a broader than local market. The government is quite happy for businesses to be formed to service southeast Queensland, for argument's sake, or southern parts of New South Wales, but they want the companies that are going to get support under this type of company structure to be looking to a larger area than just those smaller geographical areas. So they want to know that they can go further than the local market. And do they demonstrate that there's some competitive advantage? Because if there's no competitive advantage, it's hard to envisage that there's going to be any real future in this business. So they're the 5 questions. We've got the first one. I'll just go back to it. Genuinely focused. This is not just a little sideline. This has got to be genuinely focused. And the board of directors, leadership team, and anyone else involved. And those other 4 questions that we've got there. If they satisfy that, there's a due diligence report to be submitted, but then those companies should submit that to the tax office for approval. The tax office and Oz Industry take about 6 weeks to issue the approvals. They come back and issue a letter and say, yeah, we're satisfied that this company meets the requirements to define itself as a early stage innovation company. Now, what's the benefit of that, you might ask? We then get into the discussions with potential investors, because this company's got to raise money. Earlier, I talked about a accelerating special grant, the accelerating commercialization grant. Got mixed up with my grants there for a moment. Accelerating commercialization grant. And we assumed that the company might be eligible to obtain a grant of $1 million, but that's only 50%. They've got to match it. And the inventors, the founders of this company, have spent all their money getting to this stage in developing a prototype. And they're now wanting to go further. Well, the Accelerating Commercialization Grant can assist them do that. So they might have decided that they will try to raise money in this way from investors. So there then needs to be discussions with investors. And many investors are aware of the early stage innovation company benefits, which I'm about to share with you. So the investor benefits are that the government introduced that if they are a sophisticated investor, and that simply is someone who has a net worth in excess of $2.5 million, who gets a certificate signed by an accountant verifying that. So that person can obtain a 20% tax rebate based on their investment. And it cuts out at $200,000, which obviously is linked to $1 million contribution into the company. And if the investor is a retail investor, so that's everyone else, they also get a 20% tax rebate, but the maximum rebate is $10,000 because the government has restricted the maximum investment that a retail investor can make to $50,000 per company. So they can get $10,000 back. And if they can't use all that in the first year, it carries forward. But there's also a potential capital gains tax exemption. If the shares are held for longer than 12 months and less than 10 years, there's no capital gains tax paid on those shares when they're sold. If the shares are held for longer than 10 years, at the end of the 10 years, the company is revalued and these original investors receive a new cost price, which basically still locks in a significant capital gains tax exemption. So that's how that system works. The real benefit is that the company that meets the requirements to be deemed to be an early stage innovation company is very attractive to investors because there's no other investments in Australia that an investor receives a 20% tax rebate based on their amount of investment from the tax commissioner. And there's nothing else that an investor can invest in that might enable them to obtain a tax-free capital gain. Very significant. What's going to be needed in the business to get the due diligence review completed? Well, as always, when we're dealing with companies, there needs to be a business plan. There needs to be a budget and a cash flow forecast looking at the next 3 to 5 years. Where's this business going to go? What's the picture look like? What's the financial picture look like? And I think there's a strong need for corporate governance awareness in all companies, to be honest, but most particularly in this type, the early stage innovation company, because there's really little doubt that these investors who are going to come on board, many of them could be sophisticated investors, are going to be asking questions about who's on the board of directors. And they'll be looking for representation on the board by some of these new investors. And on your board, you're then likely to get some very experienced directors. And this will be great for you and your company because you will get the benefit of their knowledge and their experience. But you don't want to be caught out on basics, do you, on corporate governance? So many company directors need to do some brushing up before they start appointing new, very experienced people to their board of directors. Okay, so what can Towers Business Development do to assist you? We've had considerable experience in this field. We write material on this for accountants all over Australia through our associated company, ESS BIZTOOLS. So we can assist companies with each of these capital raising opportunities, mentoring on the requirements of the various capital raising. They are all different. Section 708, crowdsource funding and early stage innovation company have all got variables that directors and leadership team members need to understand. We can introduce you and liaise with you in your dealings with a crowdsource funding intermediary. We have profiles on the intermediaries available on our website. And we can prepare the due diligence reports for the early stage innovation company capital raising process, irrespective of where your company is in Australia. The technology and Zoom enables us to do a lot more things these days. We can meet with the directors and leadership team for the development of the business plan. And again, a fair bit of that could be done by Zoom. And we can do the same process for the preparation of budgets and cash flow forecasts and projected balance sheets that will give the key documentation that you as directors or leadership team members are going to require for any type of capital raising that we've discussed today. And we can also offer virtual chief financial officer services for those companies that wish to have those services provided, because many of the companies are going to be looking to having a part-time arrangement with someone with considerable experience, making sure that the required reports are being prepared each week, each month, so they can be submitted to the leadership team meetings and the board of directors meetings. I don't seem to have any questions. So I'm going to suggest that if you have questions now from what you've been watching in your own time, please send me an email, peter@towersbusiness.com.au. So if you want more information, why not go to our website, www.towersbusiness.com.au, where you can see some overviews of the sort of services that we offer. Incidentally, we don't do taxation work. I finished taxation work some years ago. So we are looking at helping companies to get started, to grow, to scale up, to expand. And you can have someone else do your taxation work. You can send me an email if you want more information, peter@towersbusiness.com.au, or give me a phone call, 1-800-232-088. Thank you for watching. Have a great day. Goodbye. And I hope that if you are contemplating raising capital in your business, that you are very successful with it. Have a good day. Bye.